Welcome to this very special interview and happy Diwali to you and to your entire family. I wish you a prosperous new year where all of your investments do very, very well, and that's my heartfelt wish to you and to your family. I have a special treat for you this weekend. We're in conversation with Nilesh Shah. Nilesh, thank you so much for for spending time with us, especially on a weekend like this. It is a weekend where we all hope for great prosperity, not just for the year to come, but for the long term. And one of the things I wanted to chat with you about is a view you had in a column that you wrote recently, saying using the SIP route is the simplest and easiest way to getting wealthy over the long term that's available to every Indian today. Is this the right time to sort of get started? If I'm an investor who's never used an SIP before, should I just go out and do it today?
So, we are in the Diwali festival. It's the festival of spreading knowledge. We light lamps to dispel darkness. I think in the country we need Diwali spirit. We need to light financial education to dispel this poverty. The best time to do SIP was probably 20 years back, and the second best time is today.
Okay.
We are at a cusp where, purely from a market point of view, fundamentally your current account deficit, fiscal deficit, all the big numbers which you can think of are in a right shape. On a flow point of view, now the FII and the DII both are putting their money into the country. In a very simple sense, if I see between 91 to 2015, our GDP moved from somewhere around $275 billion to $2 trillion. So roughly 1.7, $1.8 trillion increase. And on back of that growth, we created $1.3 trillion increase in the market cap. Now you go to the most pessimist person on India today. His view will be that India will become $2 to $4 trillion economy in next 15-20 years. If you go to the most optimist person on India today, he'll say that we'll achieve this in 7-10 years. Now the life is always mix of grey rather than pure black and white. So in the foreseeable future, we will see India doubling its GDP, and that $2 trillion increase in GDP should translate into some increase in the market cap. And that market cap increase will be probably more than what we saw between 1991 to 2015. So we are lucky to be present here, alive here. We just have to grab the opportunity. And SIP is the best way for an uninformed investor, for a person who is not really monitoring things on a day-to-day basis. So SIP is the best, and today is the day.
I'm going to step back from the SIP a little bit, because we do know there are a lot of viewers who write into our shows who are still using the PPF, for example, or they're using fixed deposits, they're using recurring deposits. They get excited at the idea of an issue that comes from the government in terms of bonds or in terms of small savings. That's not possibly the way to take advantage of the opportunity you're talking about. I want you to explain to our viewers how, if I lock up my money in a PPF while I already have a running PF from my salary, I'm actually avoiding the opportunity altogether.
So let's ask your viewers simple question: what do you eat? Do you eat salad because it's healthy? Do you eat only the dessert because it's sweet? Do you eat farsan because it's tasty? If you just gorge on one side, eating only salad and drinking only karela ka juice, you won't enjoy life. You may have a better health, but enjoyment, joy, fun will be missing. And if I only eat samosas, I'll have a lot of fun initially, but then I'll pay the price in terms of bad health. In our physical health, we balance between health and joy. We start with soup and salad. We probably eat once in a while a sweet and samosa also. So we are always balancing health and joy. Now in financial health, if you remain only invested in fixed deposits and PPF and provident fund, you are only focusing on salad. It will give you health but no fun. Now you need to add some spice into this portfolio through equity. It will give you fun in terms of better return. Obviously it's slightly tangy in terms of volatility. But what you're doing for your physical health by way of asset allocation between debt, equity, real estate, commodity, currency, please do the same for your financial health.
All right. So now that we say that, okay, equity is possibly the best, we have to have a balance of all of that. I also, before we move into the specifics of equity, I also want to very quickly ask you about gold. It is the season where Indians prefer to go out and buy gold. We've said this several times in the show in the past that right now, if you're insisting on buying gold, you should possibly buy it as a consumption because you enjoy wearing jewelry, not specifically as an investment. Where do you stand right now on gold, given everything the government is doing? So as a retail investor at this point, especially since you're running a mutual fund company at this point, the gold bond that the government at the RBI is offering me seems far more lucrative than the ETF or the fund of funds. So if I'm going to consider gold at all as an asset, A, do you recommend it? And B, what is the best way to do so?
So one, if you love your country, don't invest in gold.
Okay.
A patriotic Indian will do disservice to the country called India by investing in gold, primarily because we already have bought far more gold than necessary. We have some 25,000 tons of gold. No one knows exactly what is the real holding because there are so many Padmanabha Swami temples which hasn't been yet opened. Second, in last 10 years, we have bought $221 billion of gold, silver, diamond on a net basis. It is more than what the FIIs have given to us by way of flows into debt and equity market put together of $190 billion. It is more than the FDI flows which came to us over last 10 years of $170 billion. A poor country like India, because its citizens are obsessed with a metal called gold, is exporting capital overseas, whereas it needs money to build school, colleges, hospitals and so on and so forth. So purely from a nationalist point of view, think twice before you buy gold. The second thing is, forget the country, look at individual interest. Today when you buy gold in India, you pay 10% import duty, which means buying gold today in Mumbai and selling it in Dubai leaves you with 10% loss. Most of us buy gold in jewelry form. You have to pay making charges. Now if you are going to use jewelry every day, fine. But if it's going to remain in your safe deposit locker, it's not worth it. Many of us buy gold in smaller denomination because one day my kid will get married and I need that gold. So we buy 2 gram, 5 gram, 10 gram, 15 gram, 20 gram. You pay premium for buying smaller denomination gold, which ranges between 10% to 30%. So someone who is buying smaller denomination gold today is losing probably between 20% to 40% every time he buys gold. In equity, if you buy equity, potentially there is a loss of such nature. In gold, when you buy in smaller denomination, it is guaranteed loss. Might as well invest into schemes which is launched by the government called gold bond, gold monetization. Take advantage of it. It's a fantastic scheme. Good for you, good for country. You can't do better thing than this.
All right, so we've talked about debt, we've talked about gold. The other asset class that I want to ask you about also is real estate. Now, it's obvious that we all need a house to live in. The whole debate of rent versus buy is a separate debate for a separate day. But a lot of people also write into us saying that should we be using the funds that we have to buy a house at this point, or should we use it to invest in equity and maybe look at buying a house in the future, or maybe given where the expenses are right now, it doesn't make sense. I just want to get your educated outlook right now on the real estate sector. Do you think the prices will come down from here because they really should, or do you think that as soon as I'm able to buy a home, I should go ahead and do so?
So buying first house is a lot of emotional decision rather than commercial decision. I wouldn't like to step into it because it
tends to be very individual.
There's no logic behind it. It's driven by emotions also. But keeping that aside, should I evaluate real estate vis-a-vis, let's say, other form of investment? Now, today in most parts of India, real estate prices are fairly high related to their historical average, related to buying capacity, related to the stock which is lying unsold. So while location to location things can be different, one thumb rule people can say that yes, in real estate today, there is a potential that either we will see time correction or we will see price correction. the best way to invest in real estate is if you can figure out in which side the city is expanding. So if I was smart enough to pick up that the commercial capital of Mumbai will move from Fort, Nariman Point and Ballard Estate to BKC, and I can buy property ahead of that, I will make a lot of money. But if I'm an average investor who does not predict the trend and remains in Ballard Estate or Fort or Nariman Point, probably I'm not going to make great return in real estate. So try to pick up a property where the city is expanding, be it residential, be it commercial. And if you can actually put that on rent, especially commercial property which gives decent return compared to fixed income investment, then you have a far better winning combination.
All right, it's time for us to take a very quick break, but when we come back from the break, we'll go back to the fact that right now it does seem like equity is the strongest of all of those options. So how can you and I take advantage of this opportunity and make the most of it? That's on the other side. Don't go anywhere. Welcome back to this very, very special Diwali episode of Investors Guide. Nilesh, thank you so much for spending time with us. Before we went into break, we talked about the various asset classes that are available to us as retail investors. And after visiting each of those asset classes, equity still stands the strongest, head and shoulders above everybody else, given the opportunity that equity is offering us today. There also is a view that we've heard about and read about that there's a commodity slowdown across the globe. Crude is cooling off. It doesn't seem that that's going to change anytime soon. A lot of the very large developed countries are seeing a slowdown as well, and that eventually, because the world is flat, it will catch up with India. Is that something, A, you agree with, and B, even if you do agree with, is that something that I should worry about as a retail investor?
So in my lifetime, I have gone so many times wrong predicting commodities that now I have realized that I have no ability to predict future.
Okay.
When the oil prices were at 100 plus, there were many research reports which talked about oil going to 200. That never happened. When oil prices came down to 40, there was a research report talking about oil going to 20. Probably unlikely that that will happen. Our job as an investor is to invest in companies which will be able to ride over all these volatilities, because these volatilities will occur. Today crude is 45, tomorrow it could be 100, it could be 20, who knows where it will go.
So what do I do then as an investor, as a retail investor? Because there's so much information coming in.
I try to pick up longer term trend.
Okay.
There was a time when I could see that while the father was driving scooter, the son was going into motorbike. And eventually even the father shifted to motorbike. Now, picking up that trend where people shifted from scooter to motorbike, if you had picked up good companies making motorbikes, you would have made enough money. If you had picked up bad companies making motorbikes, you would have lost a lot of money. If you had picked up bad company making scooters, you would have lost entire capital.
Money.
Similarly, I also noticed that when I was going to school, I was taking khakra and puri, homemade items into my tiffin bag. But now when my daughters are going to school, they are taking biscuits rather than homemade things. And within biscuits, from glucose biscuits, now I have cream biscuits and so on and so forth. So this trend again meant that if I ended up picking up a good company which is focused on doing this thing, I'll make a lot of money. So as an investor, whatever you are consuming, whatever you are observing, if you can pick up those trends, pick up companies which are riding on those trends, majority of time you will make a lot of money.
So other than the biscuits, what are the other trends you've noticed right now?
So let's see, my father spent much less money on my education than I'm going to spend on my daughter's education. So there is one trend available. But understanding this trend is far, far easier than picking up the companies which can ride on this trend. You also want to buy good businesses with good managers, because that's guaranteed to make money. If you buy bad managers in good business or buy good managers in bad business, you'll probably not make money.
One of the other thing you said is that even if you picked a bad company making motorbikes, you still wouldn't make a lot of money. So the tough part is actually being able to tell the good companies and the bad companies. So what's the checklist that you're using?
See, partly you learn from your experience by not repeating the mistakes. Partly you try to learn from others' experience by picking up what mistakes they've made. But at the end of it, it's an art, not a science. You read balance sheet, you meet vendors, lenders, suppliers, employees, you try to form an opinion, and then you keep on verifying that opinion at all points of time whenever an event happens or a result come out, to test the hypothesis, am I with a good manager in good business or not? One very interesting observation which we saw, that somewhere below 40, and 40 is an artificial number, don't take it literally, there is hunger but not the maturity or experience. And above 50 there is lots of maturity and experience but probably a little less hunger. So if I can create an ideal combination of hunger and maturity, which is lying somewhere between 40 to 50 years of age, that's a winning combination. But as I mentioned, 40 and 50 are figurative numbers, don't take them literally. Someone of 25 years of age can be as matured as someone of 50 years of age.
You know, in fact, when we talk about learning from mistakes, one of the unfortunate things is that retail investors, we don't have enough bandwidth to make a lot of mistakes, because a lot of times an investor comes into the stock market, if he burns his fingers, he tends never to come back. If I were going the mutual fund route then, because then that would be the natural way to go, how do I pick the fund?
See, again, look at the long-term performance of that fund house, look at their portfolios, look at their investment process. I mean, most of the time people ignore the investment process. Has the return come because the fund manager is lucky, or has the return come because he had a design or a method in the madness? I will put my money with the guy who have the skill and the technique rather than just the luck. Luck can desert you anytime. As they say in cricket, class is permanent, form is temporary. Go for the fund managers with the class rather than the form.
You know, this has always been my pet grouse with the mutual fund industry, and I've been bringing it up now for nearly a decade, that we have so many funds in this industry, and a lot of times the fund name isn't exactly representative of what the fund is actually doing. There's a lot of duplication even within fund houses of funds that are constantly being launched that all do the same thing, which really adds to the chaos in the market right now. If we've reached a point through this conversation where as an investor I'm saying, okay, I understand what you're saying, I should do equity, I should do mutual funds, I should do mutual funds through an SIP. I now approach the market and I have large cap, mid cap, multi cap, small cap, then there are, you know, thematic funds, there are sectoral funds, there are international funds. How do I wade through all of that and decide what, because choosing the fund manager then is a much later process. Actually figuring out what to do in my portfolio becomes more difficult.
So now no one can accuse Kotak Mutual Fund of doing this.
Okay.
SEBI allowed consolidation of schemes. We have taken advantage of that many years ago. Today, I'm running my funds like my kids.
Okay.
I don't have more than what I can afford. I have just one large cap fund, one mid cap fund, one multi cap fund, one tax plan. Our whole objective is to ensure that Kotak Mutual Fund's investors' return is equivalent to Kotak Mutual Fund funds return.
Right.
I don't want to have the luxury of having 3-4 large cap funds. One of them will do well. Heck, if the investors are invested into that fund or not doesn't matter. So clearly, with SEBI's push on consolidation of schemes, a polarization will occur at the investor and at the distributor end, that we just want one fund in each category, one large cap, one mid cap, one small cap, one multi cap, period. I'm
assuming it makes it easier for you to focus the attention of
Absolutely.
Your team as well.
But it requires a lot of guts and a lot of courage, because if I have ability to throw 100 darts, few will always stick on the target. But if I have only 4 arrows to shoot, I need to be 100% sure of what I'm shooting at.
Okay, so let's assume then that we do pick our funds. We've had a year so far where the mid-cap funds have done better than the large-cap funds. The entire category has been a little slow given where the market is right now. There's a tendency also, and I've noticed this among the investors who write to us, to sort of sit up and ask us that, okay, now should we shift out of the large cap to the mid caps, because it does seem like the return is in that area. There's a risk involved in doing that. What would you advise?
I just want to ask those people that you took out a ticket from Mumbai to Churchgate to Borivali. Now you are in the slow train or you are in the fast train, and you saw some other train passing by you. You don't jump over from your train to the other train because it is running faster. I mean, if you stay in that train, you will reach your destination. You should have taken the call at Churchgate. Do you want to go in a slow train so that the jerks are limited? Or do you want to go into the fast train where probably jerks are more? Once you have chosen the train, don't jump out simply because the other train is running faster. Maintain your allocation at the beginning, don't change it midway. When you drive a car, you don't look at rear view alone. Most of the time you have to look at forward also. It's the forward view which helps you avoid accidents. So do a blending of forward and rear rather than just focusing on rear.
You know, there's another question that keeps coming up, and the question of fund managers. And we are an industry that has some celebrity fund managers, or star fund managers as we call them. You yourself, have been one of them for a fairly long period of time. But a fund manager switches companies. Now you're with Kotak. There might be a lot of investors who will similarly ask, now that the train driver has changed, should I switch to the next train? What advice would you give those investors?
See, none of us are immortal. Without changing also we can disappear. Now you can't rely upon a person for delivery. There has to be a process. If I'm able to sit here, it means that my team member is working down below. If they are not working, I can't sit here. So I do get all the credit for being the face, but there is a machinery which is working, and it is because of them that I'm able to sit here. Don't focus on individuals. Of course, individuals can make a difference, but if they are not backed by the team, it can't happen. I mean, one Imran Khan, one Mahendra Singh Dhoni, their leadership is excellent, no doubt about it. But there is 10 other team members who fight for it so that they are successful captains.
All right. I'm being told we're quickly running out of time, but I want your takeaway right now as a Diwali gift to the viewers of this show. If you were to give us one piece of advice that we could use for the next 1 year in our investments, what would that be?
Keep sipping. It's joyful.
Keep sipping is joyful. All right. So the big takeaway is it's going to be a year, it's going to be the next decade at least of equity. And we should really not give up on this opportunity and take this opportunity. Use mutual funds, especially because we don't have the time to really track our stocks. And of course, use the SIP format. Thank you so much for the time you spent with us, and happy Diwali to you.
Happy Diwali to your viewers too.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.